The following podcast was recorded on Wednesday, December 6th, 2023. To hear the podcast in real time, you can sign up for a free trial at arborresearch.com or biancoresearch.com or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to the latest edition of Talking Data. I'm your host, Kristen Radosh with Arbor Research and Trading, joined today by our commentator, Jim Bianco of Bianco Research. Welcome, Jim.
Thanks for having me.
Today, Jim discusses the return of liquidity and what it is doing to asset prices. Jim, November's rally was among the top 10 best months for the S&P 500. What is going on with rates and financial conditions?
Yeah, so a lot has changed in the last month or so. And if we go to the first chart, it really summarizes what's been going on. This is the forward curve of the Fed fund futures. In other words, what is the market pricing in between now and the end of 2024? So over the next year. And the orange line shows you 2 weeks ago, November 24th. And I've got some horizontal lines on it, excuse me. And it shows you that on November 24th, the market was pricing in 3 rate cuts for the year, in June, in September, and in December. But now there's been a massive shift, largely because of the miss or the CPI report coming in a little bit lighter than expected, and some Fed talk about pausing, that it's now shifted down to 5 rate cuts. And rate cut 25 basis points, so 5 would put you at 4 to 4.25 as the funds rate at the end of next year. So what's going on with rates is everybody's gotten themselves all excited that the Fed is going to be cutting aggressively in 2024. What's that mean for financial conditions? If we go to the next chart, this is the Goldman Sachs Financial Conditions Index. Now, lots of people have financial conditions indexes. They all differ a little bit depending on how you measure them, but they generally give the same measure. Goldman's is interesting because it does measure it in terms of the equivalent of Fed fund futures basis points. So this is the monthly change is what we're looking at. And if you look at November, it's down 90 basis points. In other words, the rally in the bond stock market, as you mentioned, it was up nearly 10%, the S&P, one of the 10 best months in history. And the big decline in interest rates, we were over 5% on the 10-year note at the beginning of the month, and we're in the low 4% as we start December, that the combination of those two is, according to Goldman Sachs's index, the equivalent of the Fed cutting the funds rate 90 basis points, or 4 times, 425 basis point cuts, the fourth one being a partial one, but more than 50% of it. So the Fed cutting 4 times in the month of November. That's why stocks got excited, that's why the markets got excited, is this massive easing of financial conditions is what seemed to have occurred during the month. Now, the fear is with that financial easing is that this is going to make people feel frisky, to use a technical term, and they're going to want to go out and they're going to want to spend money, and they're going to feel really good about paying up, even though inflation has been pushing prices higher, and it will lead to a rebound in the economy. We'll have to see whether or not that happens or not, but what's happening with rates and financial conditions? Rates have gone down, and financial conditions have gotten a lot easier.
What does it mean for market liquidity?
Yeah, so this is really, or how does market liquidity, what does it mean for market liquidity? Let's go to the next chart and let's talk about market liquidity. Now, there's a perception in the market that we've got draining of liquidity. This is the Fed's balance sheet. This is the asset side of their balance sheet. How many assets does the Fed own? And it's broken down by colors. They have $4 trillion that they own in treasury notes and bonds. They've got $2.44 trillion of mortgage securities that they own. And then they own, some treasury bills, some floating rate notes, and some agencies. All told, their balance sheet on the asset side is $7.18 trillion of of securities. Only BlackRock is larger than the Fed. They're around $10 trillion. You could see that from April of 22, as the chart shows, they've gone from 8.4 to $7.2 trillion. This is quantitative tightening. This is $7 trillion of bonds, more than $100 billion worth of bonds a month mature. The Fed then, when a bond matures, they buy back at around 100 months average, or around 8.5 years average maturity. So bonds mature today, they buy back at around 8.5 years on average. Less $95 billion. So they don't reinvest every proceed, they reinvest all of it, less $95 billion. That's the quantitative tightening that we've been seeing. That is the fall in their balance sheet that we've been talking about. Now, if we go to the next chart, there's been a big offset to that. And this is the Fed's reverse repo facility. And this is largely misunderstood. So try to put this in perspective. So in April of 21, the beginning of this chart, it was effectively at zero. There was a couple of $1 billion in this facility. What is this facility? For starters, you can, if you have cash, you can, and you are a counterparty for the Fed. I'll talk about who they are in a second. You can put your money with the Fed and you will get an interest rate on a one-day maturity, overnight maturity. The interest rate you will get is 20 basis points below the high end of the target range. What does that mean in English? The Fed fund target range is 5.25 to 5.5. 20 basis points below that is 5.2% or 5.3%, excuse me. So if you put your money with the Fed, it's a one-day loan to the Fed, and they will give you an annualized rate of 5.3%. That's very competitive. And a lot of people were putting their money into, by the time you got to late 22, early 23, there was easily over $2.2 trillion in the Fed's reverse repo facility. And now that has been falling from $2 trillion, that as late as end of September, it still had $1.5 trillion in it. And now it has roughly half that, around $800 billion in this fund. So if we go to the next chart, the real question is, who owns all of these? Who participates in the reverse repo facility? This is one of the big mistakes you'll hear people talk about. The banking system. The banking system did this, or the banking system did that. Well, what this chart shows here is the black line on the top panel is the total amount of reverse repo in the facility as of the end of September, and that was $1.14 trillion. That's the monthly average, by the way. And then it shows you how much is owned by government money market funds, prime money market funds, and tax-exempt money market funds. And the bottom panel shows you the percentage of the reverse repo facility in money market funds, and it's 95%. So basically, the entire repo facility is held by money market funds, not by banks. Why not by banks? Because remember I said that they get 20 basis points below the top end of the range, which is 550, so you get a 530 interest rate. The Fed also pays banks on excess reserves 10 basis points below the top end of the facility at 540. So why would a bank take their money that's getting 540 from the Fed and put it into a different Fed facility that's giving them 530? They don't. That's why there's no banks. So 95% of it is in money market funds, and the other 5% is government-sponsored enterprises like the federal home loan banks and Fannie and Freddie. So that's who plays in this. Now, why is it falling? If we go to the next chart, if you look at interest rates, this just shows you, the black line shows you the Fed's repo facility at 530. That's the yield of that. And then I show you the 1-month bill, the 3-month bill, and interest on reserves, which is what banks get, which is 10 basis points higher. Well, the red line and the blue line, which is the 1-month bill and the 3-month bill, are higher yields. So why aren't money market funds reaching for yield by going to those higher yields? Well, they are beginning to do that now, but largely until a couple of months ago, they weren't doing that. Now, why don't money market funds do that? And it's important to understand the mechanics of this so it makes more sense. When you're a money market fund, you own very short-term securities. They mature, in the case of a reverse repo, the next day, one day, or maybe in a couple of weeks or a few months. You buy these securities at issuance date, and you usually hold them to maturity because they're very short term. If you own a 1-month bill and you want to sell it a week before maturity, you could call a broker and you could get a bid and an offer on it, but it's not going to be that good. It's going to be a wide bid and offer, and you could wind up losing the excess interest you would get on this security that would be above the black line just in trading out of it. So you don't usually trade out of these. You usually hold them to maturity. So if we go to the next chart, what you see here is the average maturity. The top line is the average interest rate in a money market fund, which is very dependent on where the Fed has interest rates and treasury bills are. And the orange in the bottom is the average maturity of the assets held or the securities held by a money market fund in days. So by, if you look at the chart, what you'll notice is when interest rates go up, the number of days of the average maturity goes down. Why is that? Because when interest rates are rising, I don't want to lock into a 3-month rate today and then watch the Fed raise rates above that rate that I locked in and then have to wait for that security to mature so I could go out and buy a higher yielding security. I want to shorten up. I want my securities to mature as fast as possible so when the Fed raises rates, I can then go out and get another security at that higher rate. I don't want to sell these before maturity. So when interest rates are going up, what you typically see is the maturities fall. When interest rates start going down, now that interest rates are going down, I want to reach out and find the highest point on the yield curve many months out. I want to buy that and lock that in. So as interest rates fall, I'm still getting paid that higher coupon, at least until maturity. So what you'll see on this chart is by January of this year, it fell to 15 days, the average maturity in a money market fund. That was the shortest that they've ever been, at least in the 25 years of data that we're showing here right now. And since September, it's gone from 22 days to 33 days, or a 50% increase in the average maturity. What I'm trying to say is, since September, everybody said, oh, now the Fed's on hold, there will be no more rate hikes. And since there's going to be no more rate hikes and those 3-month and 1-month bills are yielding more, I'm going to reach out for those 3-month and 1-month bills and lock in those higher yields because I'm not at risk. The Fed will keep raising rates and those will become lower than the current funds rate. So if we go to the next chart, what the next chart shows is the effect that this is having. Let me go back and remind everybody that when I showed you the reverse repo chart 2 charts ago, it was falling. When money is at the Fed, it is still money, but it's money outside of the financial system. It is no longer part of the financial system, but it still exists as money. When repo falls, what does that mean? That means that that money that was outside the financial system, parked at the Fed, is getting parked back into the financial system. And anytime money goes back into the financial system, whether it's a money market fund or an ETF or something, it winds up as its counterparty being a bank reserve. So if you look at the top chart, this shows you bank reserves. And you'll see that in September of 21, bank reserves peaked at $4.19 trillion, and they fell until February at $3 trillion. Now, part of that was quantitative tightening. The Fed was draining reserves out of the financial system to the tune of $95 billion a month. But now that all of a sudden the Fed's on hold, I'm going to reach for a longer yielding treasury bill. I'm going to take my money out of reverse repo at the Fed. I'm going to put my money into a treasury bill. That's reintroducing that money back into the financial system. And since February, even though the Fed continues to do QT, bank reserves have been rising. And you can see with yields on the bottom panel as well. So those bank reserves have been rising along the way. So what this has been doing is it's been adding liquidity to the financial system. So we are in a QT period, but it's almost like we're back to a QE period because this fall of this belief that the Fed is done, all this money is leaving the reverse repo facility, which means it's leaving to go back into the financial system. It's showing up as more bank reserves. It's buying more assets. It's providing more liquidity to things, and it all comes back to the Fed's done. The Fed's going to be cutting rates. Grab even a 6-month bill at 5.4% if you can, because in 4 months you're going to be happy you're getting that yield, because the Fed might be cutting rates, and those overnight rates will be much lower, and that's adding liquidity to the financial system.
Jim, what does this mean for markets?
So if we go to the last chart here on the list, the green line is called cumulative change. This is bank reserves. This is the reverse repo facility, and another thing that's also very similar to the reverse repo facility and how it works, and that's the Treasury General Account. That's like the federal government's checking account. Well, there's $680 billion in that account. Well, that's money, but it's outside the financial system. When that money goes back into the financial system, when the TGA is falling, it's not money's disappearing or being destroyed, it's being shoved back into the financial system. That's also liquidity. So that green line, which is called cumulative change, is rising. And so that means liquidity is coming back into the system. The orange line is the S&P 500. It correlates very well with it. So what's been going on over the last month or so is liquidity has been coming back into the system, driven by the Fed's done. I don't need to keep $2 trillion in reverse repo anymore as a money market fund. I will then shove that money back into the financial system and buy a 3-month, 6-month, or 1-month bill, and that is adding liquidity, and the market is having a liquidity or an everything rally. Stocks are going up, bonds are going up, even gold is going up, because we're having a liquidity rally. Now, how much longer is this rally going to last? That's a very good question. Well, if we could back up a few charts back to my reverse repo chart, maybe I'll go back about 3 or so to the reverse repo chart. What that will show you is that as reverse repo is falling, go back one more chart. One more after that. Thank you, Mr. Chart Changer. As repo has been falling, the question is, what is the eventual level that it will hit zero, or will bottom out at? Will it bottom out at zero again? I don't think it will bottom out at zero again, because as a money market fund, they do a lot of modeling, right? I run a money market fund. It's got billions of dollars in it. I've got thousands of people that have their money in money market funds. Well, every day people withdraw their money. They buy a house, they buy groceries, they pay taxes. I have to figure out what my cash flow is going to be, and I have to anticipate that I've got money to be my cash flow, and then I have to anticipate that I have a little extra reserve in case I miss on my cash flow, because I don't want to have to sell a 6-month treasury bill with 3 months to go, because then it will make my yield, my yield fall on my fund, and they're very much sold on yield. So I'm going to guess that this number is probably going to bottom out at somewhere between $200 and $400 billion, because money market funds need some level of instruments that mature tomorrow, and then you just roll them over every day, so that if you have a cash need from the people in your fund, you've got cash to give them. And if they don't need the cash, you just roll it over the next day and the next day and the next day. So there's always cash ready tomorrow. So if this is going to fall, if this is going to bottom at $200 to $400 billion, and we've gone from $2 trillion to $800 billion, 3/4 of the way through that liquidity increase that we've seen. And we've probably got another 400 to 600 billion to go. We could probably see that done in another month or so as far as the liquidity goes. So yes, liquidity is helping the market. Yes, there's more to go, but the vast majority of it has already been pushed back into the system. There's probably a little bit more to go, and we're probably measuring it on weeks to a month, or maybe 2 at the most, and not several months or quarters is how we would be measuring this potential liquidity. So yeah, liquidity will help. So hopefully this all puts into perspective that the QT that everybody was talking about has been offset with this fall in the reverse repo facility, and it's been adding liquidity, and markets have been responding with the everything rally to this added liquidity, kicked off by the Fed's done, so reach for yield. Get your money out of that overnight repo at the Fed and get it back in the financial system to buy a 6-month bill. And so that's what's been happening, but we're most of the way through it. We've got a little bit more to go. So it should benefit the market from a liquidity standpoint. But like I said, I think we're talking about weeks or a month or so, not several months or quarters of improved liquidity.
Jim, thank you for your thoughts today, and thank you everyone for joining us. If you have any questions on Arbor Research, Bianco Research, or Arbor Data Science, you can contact us by emailing Gus Handler at gus.handler@arborresearch.com. Thanks again, and have a great day.